What is going on? I hope everybody's having a great weekend. Happy Sunday. Welcome to my channel. I'm the covered call guy. My goal is to create 120,000 in annual passive income using only covered call ETFs. Right now my portfolio yields about $76,000 a year, 6.3k a month, 1.4k a week, and about $200 per day. Legal disclaimer before we start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. Now, with that out the way, today's video is I guess it's a little bit based on a conversation I had with a friend. If you're new, I had a friend that I talked about that has a few million invested, but he does pure dividend growth investing with 3% yield or less. I've kind of been transparent with him about, cover call ETFs for income investing with at least 5 to 5, 7, 8, 10% that are still safe, quote unquote safe. I told him that I almost went all in on NEOS, and he just kind of started digging around NEOS, and he said, you know what, NEOS basically has all of the income spectrum. Why not all NEOS? And for those who are if you're new, I made a video about how I almost went in all in on NEOS. First was the BTCI, and then I did SPYI, QQQI, and BTCI, but I didn't all in. And then there are comments on my videos from time to time saying, they only do NEOS. So I'm starting to see a trend here, right? That a lot of people are kind of just focusing and narrowing on NEOS. And, I'm revisiting the topic here. It's interesting because why not all NEOS? So this video is dedicated to kind of putting reasons why and why not. So let's get started. This is the NEOS only income ecosystem. Why buy anything else? I'm gonna ask myself here, does NEOFUNDS really have it all? Let's find out. All right, a little introductions before we get started here, especially for those who are new, right? We look at the old way, and the old way is broken, right? Guys, we are facing a massive paradox here. Everyone wants yield because we are getting older, but traditional bonds are failing us. After inflation and taxes, you ask yourself, are you really making money? Probably not. This is why alternative income is taken over. Enter NEOS investment management, right? They are leading this income as at the outcome revolution. They are taking the charge. They are basically the top of the top when it comes to cover call ETFs. They are pretty much, they solidified their position with their reputation, their performance, and their assets under management proves it. All right, so I'm gonna be using the 16 ticker master plan, right? So as of right now, NEOS does only have 16 tickers, and if I were to all in NEOS, I want to own all 16, right? So I'm doing this video, I'm doing a rigorous audit of NEOS only portfolio. My goal here to see if we can concentrate everything with one issuer, right? So I validated 16 tickers across 4 asset classes. So the core equity is going to be SPYI, QQI, IWMI, NIHI. The hedge equity will be QQH, SPYH, and NLSI. The fixed income will be CSHI, BNDI, HYBI, TLTI. And the alternatives will be IAUI, MLPI, IYRI, BTCI, and NEHI. And together, this makes 16. So I will be looking at owning all 16 if I went all in with NEOS. All right, what does income as an outcome mean? It just means stop selling your shares, right? So the income factory philosophy is simple. Total return is equivalent if you have to sell shares to eat. With NEOS, I'm aiming for distributions exceeding 10 to 12% annually. This creates a self-sustaining annuity. I get cash flow independent of asset prices. This solves my SORR, which is sequence of return risk, so I can sleep at night even if the market dips. What does NEO offer me? Why do I pick NEOS? It offers the secret tax hack. What do I mean by that? Why consolidate with NEOS? The tax alpha. Option strategies usually get hammered with short-term taxes up to 37%, depending of course your income. But NEOS uses two loopholes. The first one is Section 1256 contracts. They trade on the index options, SPX, NDX. These get a blended tax rate of 60 long-term percent, 40% short-term. This is a huge, it's this huge tax advantage compared to funds like JEPI. The second is constructive return of capital. What do I mean by that? They harvest losses to offset gains, making some income return of capital. This defer taxes until I sell the fund. Now, before I get you're wrong about return of capital, I made 2 videos on that. Please watch it. Okay. I might have to make a third one for those who are new and watch. Hey, you're wrong about this. I'll probably have to make a third one. All right. Pillar 1, the core equity complex, right? Replicating the market and supercharging my yield will be the 2 SPYI with SP 500. Net asset is 6.8 billion. Yield is about 12%. Their strategy with this one is call spreads. They buy out the money call, so if the market rips, I still participate. And then QQI with NASDAQ. Net asset is 7.4 billion. Yield is 14%. The strategy here is tech heavy income. Higher volatility equal richer premiums for me. Pillar 1 of diversifying. I want to diversify the core, right? So what the 2 cores here, SPYI and QQQI, will have these 2 backing it up. Is IWMI with small cap. It does the Russell 2000, gives me exposure to that. This is my diversifier. Small caps don't always move with big tech. That's good. I like that. Plus, the volatility here is insane, making IWMI a potent yield generator of about 14%, right? Great for recovery phases. And then second to that is the international NIHI. It does the MSCI EAFE exposure. I'm solving my home country bias here, right? So investing in this gets me into Japan, United Kingdom, France, and Australia. The target yield here would give me just about 9 to 10%. It gives me exposure to industrial and financials that the US market lacks. All right, let's talk about defense. That is pillar 2, my crash protection, right? So while pillar 1 is for my offense, I want to have my back covered. So pillar 2, I'm going to be talking about my defense here, right? So QQH is the hedge version of the NASDAQ, formerly NEOSI. NEOS fixed it with a put spread collar. They now buy protective puts to create a floor against crashes. And then SPYH is the hedge SP 500. Same logic here, right? Except it does the SP 500. This is my ballast, right? This is my defense. If the market tanks, these funds won't hurt as bad as the unhedged one. And the new one, NLSI, does the long short. This is the special sauce, right? It's it covers a little bit more for the hedges. It does something a little bit different, right? This one actively goes long good stocks and short bad stocks. It's designed for uncorrelated alpha that the QQH and SPYH doesn't do. So it's perfect for when the market is flat or choppy. All right, pillar 3, bonds on steroids. Now I'm going to be inverting the traditional bond model. Instead of just clipping coupons, I'm selling volatility, right? The puts. The put right strategy, my bull case here is market flat or up. I keep the premiums plus the bond interest. Bear case, if the market crashes, my short puts lose money, but my high quality bonds, which is my treasuries, usually rally to offset it. My cash and bond anchors will be CSHI, which is my cash. This is the liquidity anchor, right? Hold T-bills, risk-free, right? Quote-unquote risk-free, plus sell puts. The target is risk-free rates at about 1.5%, right? So that is about the give or take, after your inflation or whatever it is. That's the gains you get. Not much. If anything, it could be even be just straight up zero. You're just putting it breaking even, but that's fine. This is where you put your dry powder. This is where I'll just have money to, hey, just in case I want to buy the dip, or I want to open a new position, or I want to put more money into allocations here. So that's fine. BNDI, this is my aggregated bond, my core ballast. Investment grade bonds give me about 5 to 6% yield. Then we have my treasuries, right? T-bills, TLTI. This is my crash insurance. It does the 20 plus year treasuries. If we hit a recession, this thing flies. And of course, we have the high yield of the group, HYBI. This is my yield booster. However, it does junk bonds, so be careful with this. It correlates with stocks and is a junk bond. That's why I give you the yield booster. So personally, for me, depending on how much you want to put, I would say, you know what, have this for fun. This would be the satellite position. I'll put maybe 1%, 2%, or even less. I'll just put like, it will be a small percentage, depending on how you want to play this high yield junk bonds. All right, then pillar 4, gold that pays rent. Of course, right? I have IAUI, does gold. Gold usually pays zero yield, but with IAUI, it right calls on it to generate 12% yield. It is my inflation shield that actually pays me. And then I have MLPI with this energy MLPs, right? This does pipelines and energy infrastructure. It is structured as a C corp, so no K1 tax forms. I get a simple 1099 with massive yield potential. And of course, for those who have to do K1s, it's a headache. It's for, at least for me, it's confusing. However, I no longer have to do it. I have an accountant, and plus I don't own anything right now that does gives me K1s. So the headache is gone. For those who are investing in something else that gives you K1s, good luck. I do hope you just go ahead and pay an accountant to make sure everything is filled out correctly. But K1s are a headache. All right, landlord and crypto bros, right? So IYRI does real estate, diversified REIT basket, tangible assets that hedge rent inflation. And then for the crypto bros, BTCI does Bitcoin, right? Over 20% yield, harvesting digital volatility, extremely high risk, but with that, extremely high reward. And of course, ETH NEHI is the same game as BTCI, uncorrelated to my bond yield. So these, for those who are new, I made videos about this. I love real estate and I love crypto. So of course, my allocation here would be pretty decent sized. All right, then we got to talk about the good. We talk about the bad. You know me, I like to give you guys the unfiltered truth. So let's talk about the short volatility trap. All right, I'm gonna be honest with you, there is a catch, right? Every single fund here is short volatility. What do I mean? Equity funds equal sell calls, fixed income equal sell puts. The black swan event. If the VIX spikes to if the VIX spikes to 50 plus, or it gets anywhere near that, my equity fund caps their upside. My fixed income lose money on the short puts. I have no long volatility hedge here. Maybe, and I say maybe, except TLTI, and that is dependent on how much you have in it to really give you that buffer, to give you that cushion. Otherwise, your entire portfolio tanks and get pretty much the black swan event. You could see your entire portfolio drop 30, 40, maybe more. So something to think about. And don't go ahead and say, oh, this is not going to happen. It has happened multiple times. Within the last 20 years, it has happened. All right. All eggs in one basket, right? We got to ask ourselves, what is the main risk here? For me personally, I'm going to say, if I give 100% of my money to NEOS, I have a single point of failure. If they have an operational error or regulatory issue, my whole portfolio is toast, right? The manager here is my biggest risk. And then of course the second is Congress, right? Legislative risk. That tax alpha I love, it's based on tax laws. If Congress changes section 1256, my returns drop overnight in an instant. Snap your fingers and you have lost 10-15% of your gains just like that. However, the counterpoint to this is I don't think Congress is going to be changing these type of tax laws to really negatively affect investors. Why? Well, because it would hurt their donors. It would hurt the lobbyists that lobbies these Congress members to write these favorable tax laws, right? So remember, we are the small fries, but there are multi-millionaires and multi-billionaires that do take these tax advantages themselves. So if it hurts their pockets, they're going to make sure they go ahead and fund somebody else that doesn't hurt their pockets. So there is some good points to these tax laws, right? The rich favors them too. So if the rich favors them, it helps the little guys like you and I out. So I don't think they're gonna go ahead and take this away. All right, my unified matrix allocation, right? The master plan of 16 tickers and 4 buckets. Now, this is my scenario. This is how I would play the game. Okay, this is my my guesstimate of how a solid all-in NEOS would play out. This is what I visualize what most people would do. So the bucket of core equity, weight 35%. The tickers, SPYI, QQI, IWMI, and NIHI at 35% weight. I'm assuming most people would go ahead and do that. For the fixed income would be 30% because you need that anchor, right? You don't want to be going up and down way too much. If you're all in on NEOS, that would be BNDI, CSHI, HYBI, TLTI. And then you have your alternatives, right? You want that kind of that hedge. You want something different. Would be 20% of IAUI, IYRI, MLPI, BTCI, and NEHI. And then your last, this one could be 15%, or you might go ahead and do 10% and put the extra 5% into your core. It would be your hedge alphas, right? Your QQH, your SPYH, and your NLSI. This is what I assume most people would kind of build around if you went all in. These would be the allocations, I think. Let me know if you agree with that, So I think most people would go ahead and do this for if they were all in on NEOS. All right, so if I had $1 million and I did go all in on all 16, my target annual income would be about $121,000 at a 12.15% yield, give or take. My core equities, right, SPYI, QQI, right, my allocations to that would be $350,000, giving me about $44,000 in annual income. And fixed income, right, BNDI, CHDI, what about $300,000, giving me $18,000 a year. My hedge alphas with QQH and LSI, $150,000, give me $11,000. My real estate or my alternatives, $150,000, give me $18,000 a year. And then my crypto with $50,000, give me $15K a year, with a total allocation of $1 million, giving me estimate on the low, I would say the low of just about 100,000 to anywhere upwards of 121,000. Of course, dependent on the yield, but I am aiming for the highest of 12.15% yield of the mix. However, not most people can get $1 million, right? But most people can get $500,000. I believe everyone here can be achieving, can hit the goal of at least a $500,000 starter pack. I believe $500,000 is very, very doable, and $500,000 can get you to retire, right? More realistic here, I'm recalculating my core, my fixed, and my alternatives, and my hedge here, right? So my core at 35% will have 175,000 invested, 70,000 to SPYI, 50,000 to QQI, 30,000 to IWMI, 25,000 to NIHI. Right, my fixed will be at 30% with 150,000 invested, 50 to BNDI, 50 to CHDI, 25 to HYBI, 25 to TLTI. And then, of course, alternatives, 20% with $100,000 invested, 25 split across all IAUI, IYRI, MLPI, with 12.5 split across to the crypto, BTCI, and crypto of NEHI. And then my hedge of 15% with 75,000 invested, 25 across all of the hedges. Recalculated monthly income will give me just about 5 grand, give or take. Sometimes a little bit less, sometimes a little bit more. But I think this is very, very doable. Let me know if you agree. I put 1 million because you know what? Some people could hit 1 million, but for most, I think 500,000 is very, very doable. Just, you're gonna have to make some sacrifices in your 20s and 30s, but very, very doable. I think in a 10-year time frame, from 0 to 500 to 500,000 is very, very doable. And of course, if you hit 5 grand a month, I think you can go ahead and retire at some point and move to a different country. Of course, if you're single. If you're married, I believe with dual income, you can even hit a greater, maybe 1 million, and get the 10K a month. All right, so what if the market crashes, right? Something we always got to ask about. So these are my 2 scenarios. Again, these are my what ifs. This is what I think would happen. So it's not biblically accurate. Of course, this is my take. This is my scenario. This is my makeup scenario. So scenario A is Volmageddon. I don't know how to say that. Volmagdon. That happened, I think, in 2008 and in 2018 when the VIX was over 40. The bad news was then what happened to us, what could happen to us income investors is the NAV drops as short puts increased in liability. However, the good news is my monthly yield skyrockets because premiums are insane. That means just that we're able to sell so much more fair, higher the premiums. That's it. Scenario B is deflationary crash. The bad news is my cores, SPYI and QQQI draw down hard, right? But because I have hedged, I get the good news. QQH is my hedge put gains value. TLTI, my treasuries rally 20 to 30% to save my portfolio. So because I'm covered on these spectrum, I kind of buffer out and I kind of save myself here. So I think this is what happens. NEOS does offer and does play both sides of the spectrum. So as long as I understand trade-off, I wouldn't be too scared, right? And in fact, I would probably invest more money as it dips, because if it recovers, then it would shoot up my portfolio to the moon, right? When you're buying these dips. What's missing though, right? So I did the math here. NEOS only cover 88% of the income factory. I need satellites to be complete. NEOS does not offer BTCs or private credit, right? NEOS doesn't have this. My proxy would be either MAIN or BIZD or ARCC. And NEOS does not have preferred stocks, which is hybrid of equity and debt. The banking sector exposure, right? The proxy here would be PFFA. Now, if you're just happy with what NEOS is offering, then you don't need these two. But if you get these two, then you would have complete the 100% of the spectrum of every single income. You got it all. So this is just a personal choice, a personal preference. But watch out. I'm just going to give a little trading tips here. Don't just mash the buy button. You have to check the liquidity, right? So I'm gonna say low risk market orders are okay with the tickers SPYI, QQI, BNDI, CSHI. The medium liquidity will start falling down is now limit orders or okay with IWMI, TLTI, QQH, and SPYH. Now high risk, I'm starting to say the strict limits you have to start being careful is HYBI, IAUI, IYRI, MLPI. And of course the risk here very high. It could be very low value, right? Depending on how the trading activity is. I would label these four as low, NLSI, BTCI, NEHI, and NIHI. So again, these might not be super accurate. Some of the very high could be in the high. Some of the high could be very high. Some of the medium can be high. Some of the high could be medium. But for the most part, this is how I separate it. This is just a visual. All right, the bull case. Why I love it. One, my unfair advantage. I cannot replicate Section 1256 tax efficiency on my own. It is mathematically impossible for a retail trader like me to beat the 60-40 tax split without these funds. This is real money staying in my pocket. And two, psychology, right? So psychology wins here. When the market dumps, I don't panic sell. Why? Because I get paid a fat distribution. Cash flow cures panic. That is my bull case. What about the bear case, right? The trap. The FOMO risk. If the S&P rips 25% in a year, I might only capture 14% of it, right? I am capping my upside. If I'm young and want maximum growth, okay? If I'm young and want maximum growth, this portfolio will annoy me because I will be lagging in my peers. And two, convenience fee, right? I'm paying 0.60% expense ratio across the board. For a $1 million portfolio, that's 6.8 grand a year in fees. Is the automation worth it? For me, at least, I'm going to say yes, but it's not free. Obviously, you're paying for these managers to make you money and to at least match the market, if not try and beat it, right? So this is the price you pay. My final buy order. Who is this for? The income investor. You want to retire now. You value cash flow over numbers go up. However, for me, I'm going to say my magic number is 35%. What do I mean by 35%? I am allocating 35% of my liquid portfolio here. It is my high yield engine, but I would like to keep 65% elsewhere for safety. I don't want to all in on a single issuer as much as I love NEOS. Right? Every single issuer is not the same. Every covered call ETF is not the same. I want different strategies. I want different issuers. That would be, for me, my magic number is, I will go ahead and give a large chunk, but 35% is the magic number here. Who is this not for, right? If you're watching my video and you're the 25-year-old accumulator, just buy VU and wait. You don't need income tax drag yet, right? So if you're the pure growth, you don't need the income, you have a great cushy job, you don't think you're going to get laid off anytime soon, or you have backup plans, or you have 2 jobs and you're okay with that, hey, this is not for you, right? VU and chill is your method of getting rich. Thanks for watching. Smash that like button, subscribe, comment below. Are you going all in on NEOS? Let me know. Thanks for watching. I hope this was educational, informative. Catch you guys on next. Stay tuned.